Go to this. Okay, this is where I want to be. Alright guys, a few things, alright? It's Monday, it's April 13th, 2020, about 11:30 in the morning. I survived the storm, so hopefully you guys did too. It did get a little scary. Right behind my house here is the fire station. And of course, when the warnings came through, the big siren went off. So it was a little spooky around 4 in the morning when the air raid sirens came on. But we're fine. It's sunny. It's beautiful. We got power, obviously. We do need to pray for those who have lost. Either the one person died over there in Seneca, it's not too far from us, and there may be others. And let's make sure we pray for them and make sure that we are thankful that we survived. Hopefully nobody's lost anything in terms of property or whatever else. Everything like that can be replaced. People cannot, obviously. So pray for them. Hopefully you had a blessed Easter. I mean, I know I had a very different Easter than usual. I know last year I was at a 7 a.m. sunlight service. It was beautiful. It was right on a lake. I saw the sun come up with the service. It was wonderful. And then this year I had to watch videos. I had to watch live streams. So it was different. But still, the reason for the day is unchanged. He's risen, and we love that. And we hopefully, we're all seeking redemption, and that's what Jesus brings to us. So hopefully you had a blessed Easter. I know I did, even though it was different than usual. And yeah, so we're ready to do some accounting, right? So let's talk briefly about some date changes. So I went through chapters 1. I'm sorry, not chapters, but units. So units 1, 2, and 3, all of them, I went in and extended the dates. Okay, so everything in 1, 2, and 3 has an extension until April 27, okay, which is 2 weeks from now, which is essentially the day before you'll have available to take the final, okay? And what I'm thinking here is on that Thursday, what day is that Thursday? The 30th, okay? Probably going to be the 29th. The 29th will be the last time for you to submit any work that will go into your final grade, okay? So what I'm trying to say is if you miss stuff early in the semester, it's now available for you to do again hopefully without having to contact me. Now, if you try to do something that you've done before, and you have issues, then contact me. So, in other words, if I think William, okay, one of my guys, William, okay, he missed because of a sports event, and I put in an extension. Okay, that extension's still in place, so his due date will be way back in maybe February. So if he wants to do it again, he's let me know. Hey, I want to do that again, or I didn't get to do it. So I can remove the extension so he gets the final due date, which is weird. That's how the system works, okay? So if you have any issues, okay, if you messed up and didn't get, if you messed up one of your attempts and you don't have any attempts, I'll give you an extra attempt. Just reach out to me, tell me exactly what item it is and what you need, and I'll try to get it done as soon as possible, okay? Usually it's within about 30 minutes. I'm pretty close to my email account, all right? So get stuff done if you've missed it or forgot it or whatever else. Now, chapters 8 and 9, which is the current stuff, that's due. I moved all those to Thursday night, and that's going to be the deadline, okay? I can't push it all back to the 27th because you'll delay, and you'll be out of time, and you'll come crying to me that, I didn't get it all done, okay? So chapters 8 and 9, which is Unit 4, has a hard deadline of Thursday, the 16th at midnight. Don't ask for extensions for anything. Chapter 8, 9, Exam 4, Unit Assignment 4, no extensions will be given after the 16th. So get your work done, okay? I realize it's weird times, but it's time to get our stuff finished, okay? Hopefully you'll find this before Sunday so you can get that work done. All right, chapter 10. You see the title of the chapter there on the screen. Plant assets, natural resources, intangible assets. Okay, it doesn't say assets, but it is. we're only going to really focus on the plant assets. Okay, these are physical. I've been talking about them all semester, and we're talking about vehicles, equipment, machinery, buildings, furniture, computers, land. Okay, that's a pretty good encompassing part of it. They're tangible, and they add to the value of the company, and they have lives longer than 1 year. The second one on the list, we're not going to really cover it, which is called natural resources. That's stuff like mines and timbers, okay, like timber forest of timber, okay? Stuff that you can deplete, okay? So a plant asset, when it loses value over time, we call that depreciation. Well, when you do natural resources like coal mines and iron mines or whatever you might be mining, or also like natural resources like timber, then you call that depletion. Okay, so as opposed to calling it depreciation, we call it depletion. Well, we're not going to really get into it. Okay, so don't worry about natural resources too much. Intangible assets are assets you can't touch. Stuff like trademarks, brands, copyrights, licenses. Okay, this shirt I'm wearing. Okay, now I wore it to be a little more casual, but actually it's a pretty good day to have it on. Okay, Okay, you see here it is. It's an Under Armour shirt, okay? We all know that you can't put this on a shirt unless you are the Under Armour Corporation. It's a trademark, okay? But also, there's another one here, right? The Batman symbol. This shirt was made by Under Armour. Under Armour had to pay DC Comics, people that have the intellectual rights to Batman, to put this symbol on this shirt, otherwise it would be illegal. Okay, so yeah, it's kind of a tangible thing. You can touch this shirt, but this symbol, okay, is you have to have a license fee with the comic book company to be able to put it on this shirt and legally sell it. Okay, that's intangibles. Also stuff like patents. Okay, and those tend to lose value over time too, or they can, and if they do, we won't call it depreciation. We won't call it depletion. Instead, we're going to call it amortization. Okay, but it's kind of the same thing, different wording. Okay, regardless, we're not going to spend much time on it. That's the extent of it for this chapter. Okay, now let's go to our next slide. Remember, we're focusing on plant assets. We're going to talk about what the true cost is, how to do some different forms of depreciation calculations, then also if we sell them, how do we get them off our books? Okay. So plant assets, tangible assets, we can touch them, and they're used in the company's operations, and they have useful life of more than one accounting period. Typically, the accounting period is 1 year. Okay. So typically, they're longer than a year. Might be 3 years, 5 years, 7 years, 30 years, whatever it is, more than a year. Okay, they have value and useful lives. Here's our four main issues in this chapter that resolve around the plant assets. The first one is, how are we going to compute the cost? Okay, obviously, if we're buying a machine, it's the price of the machine. But it's also going to be taxes on the machine, delivery on the machine. If we have to do some construction to have the facility ready for the machine, that will also be included in the price, okay? So we'll talk about that in just a minute. At least I think we will. Depreciation, calculating depreciation or computing depreciation. We've done one already, okay? We did the straight line method way back in chapter 3, so we will review it and do it again in this chapter. But we're going to add two more types. We're going to add units of production method, which is fairly straightforward. It's very similar to straight line method. And then the second one we're going to do is we're going to do what's called declining balance method, which is an accelerated method. It's a little more confusing, but if you can set the little chart up, it's actually pretty easy. Okay. If you can set the chart up, I'm going to do it in Excel, and if you can follow that, you'll have success in the problems. The more you do it, the easier it gets. It's very systematic. Regardless, okay, let's go on number 3. We won't spend much time on number 3, but we'll talk about it real quick right now. Okay, accounting for expenditures such as repairs and improvements of an existing plant asset. Okay, so let's think about a plant asset being a vehicle, a truck, just to make it nice and easy. We all know how cars and trucks work. If we have a truck within our company that we use for company businesses, company purposes, it's a plant asset. We'll give it a life probably of 5 years. Okay, after 5 years, it's worth X amount of dollars. We won't get into that, but certain repairs can have certain effects on that asset. Okay, so if we're just changing the tires, that's normal wear and tear. If we are changing the oil, if we are maybe changing out the fuel pump, if we're changing out the alternator or a new battery, okay, stuff like that is just regular repairs. And they don't really make much difference. They're not huge expenditures, typically. Sometimes they are. So those are just kind of like expense. We just expense that, not worry about it. But if the engine were to blow, okay, we have a 4-year-old truck, the engine blows up for whatever reason, okay, and we decide, instead of just getting rid of it, we decide to replace the engine. Okay, it's going to be probably several $1,000s. And what it's going to do, if the truck had a 5-year useful life, and after 4 years we put a new engine in it, well, heck, it might last another 4 or 5 years. So it will extend that useful life, right? So any sort of a repair that extends that useful life, we're going to want to deal with depreciation of that asset, okay? We won't do much with it, but the concept should make good sense to you, right? If I put a new engine in a 4-year-old truck, I'm probably going to drive it more than, 1 more year. So I'm going to extend that useful life, and it'll alter the depreciation a little bit going forward the next couple of years. That's a little more of an intermediate topic. We'll cover it if you're moving on to those courses. The last thing that down here that I do want you to do is the journal entries to remove assets whenever they're either junked or sold. We want to be able to take them off the books. And that'll be something that we deal with. It's a little confusing the first few times you do it. So we're going to do it a few times. It might be kind of confusing. That's what this video is for. This is a little blurry. It's just kind of a low-def picture is what the problem is. But you see here, we got to figure out the acquisition cost, okay, which is just more than the purchase price. It could be insurance. It could be shipping. It could be taxes. It could be other things needed to get it in service and in use. Maybe something like here, if it's a car, well, property taxes, the license plate fees, stuff like that. The middle one, we're going to have to allocate the cost between the periods. So if it's going to last 5 years, then we want to have some cost to each of those 5 years. And then also we have to be able to record a disposal whenever it's sold. Okay? So here's the rules here for machinery and equipment. Pretty straightforward little sentence here. The cost of machinery and equipment consists of all normal and necessary all costs. Okay, I misread it there for a second. All costs, normal and necessary, to purchase them and prepare them for their intended use. So that's what I'm saying. Taxes, shipping. If you have to, build some sort of a platform so you can use the machine properly, then that would be included as well in the cost of that machinery and equipment. Okay. If it's a building, then we would also want to consider, obviously the price of the building would be one thing, but also, the purchase price, the brokerage fees, like a real estate broker fees, okay, taxes, title fees. Okay, you're gonna have to go through a closing session to get all the mortgage, everything set up. So there'd be some attorney fees there. That would also go in there as well. Land improvements, okay. Land improvements of could be stuff like bridges and sidewalks and stuff like that. Decking, fencing. Okay, the costs include expenditures necessary to make the improvements ready for their intended use. Okay. For land, it would also be again the purchase price, the real estate commissions, just like for the buildings as well, legal fees, taxes. You could also have some attorney fees for closing as well. All right, so let's look at our three methods that we're going to deal with when we calculate depreciation now. So in the past, we did one method, which was right here, the straight line method of depreciation. We would have, here's our formula, right? It is blurry, I realize that, but it's because it's a low-res picture. It is cost minus salvage value divided by the useful life in periods. I usually use the word in years, okay? So let's revisit salvage value. Okay, salvage value is an estimate. Okay, it's an estimate. It is up to the discretion of management, and it needs to be something that's reasonable. But ultimately, it is the business's decision on what salvage value is. Some are very easy to calculate, like a car. We know what most cars are worth in 5 years based off of, what a 5-year-old car is worth now compared to the purchase price. But other stuff like certain machineries may be difficult to come up with a reasonable salvage value. The good thing about it for us is we're gonna give you the salvage value and the problems. It may be worded funny. It may not say salvage value, but it says the estimated cost in 5 years is $1,000. That is the book trying to tell you that salvage value without using the word salvage value. Okay. So I'm a little bored here. Okay, these are the 4 things that we're going to see in these problems. Okay, they've pretty much got to give you these 4 things. Cost. Okay, they're going to give you the cost. They're going to give you the salvage value, but it may not say salvage value. You might have to be a little, use this little brain up here to figure out, that means salvage value. It's going to give you potentially 2 different lives. Okay, one is the life in years. Okay, that's going to what you need for the salvage value, or for the straight line method. You got to have the life in years. Look at this one here. Life in products. Okay, now that's my wording. Okay, but look at this second method. Excuse me. The units of production method. It's almost look at the formula before we get too involved. It's the same numerator as a straight line method. Okay, it's cost minus salvage as the numerator. The only difference is the denominator. It says total units of production. Okay. What does that mean? Okay. In other words, what essentially it is the life of that asset in terms of how much it can produce in actual units or numbers. Okay. So when you look at this little problem here on the screen, it doesn't tell you a whole heck of a lot, but what it does say, what we can figure out is the cost of this machine was $10,000. The salvage value was $1,000, and look at here. So it's some sort of a shoemaking machine. I have no idea what that would be. Okay, and 36,000 shoes doesn't sound like a whole lot of shoes if you want to sell millions of them. But anyway, after this machine produces 36,000 shoes, it's going to be pretty much worn out. That's how you can kind of read this. So another thing about these units of production method, whenever we calculate the expense, they have to tell you how much you produce in that period. So I didn't leave it out. It's not on the board here, but down here, if we're doing units of production method, it's also got to tell you how many shoes, in this case, were produced during an accounting period, which is typically a year. Okay. So there is the units of production method. Okay, when we do it, you're going to see how similar it is to the straight line method. Now, they do have to give you the amount produced in order to calculate depreciation. All right. Excuse me again. The third method is called the declining balance method of depreciation. And this one is actually called double declining balance, because we're going to double the straight line method. All right, so whenever we're doing these, well, I just hit the mic. I'm sorry, that might have been very loud. Whenever we're doing these double declining balance, these declining balance methods, we have to have the straight line information. Okay, we have to have cost, salvage value, and the life in years. And in this problem, you actually get those. We get these, right? So it's kind of spread out. But let's look at it real quick. So, I think the numbers are all the same. Yeah, so we're going to use these numbers here. Actually, we do need salvage value, but not really to the end. And we're probably not going to get to it in this. So, we have a cost of $10,000. We have a salvage value of $1,000, and we got a 5-year useful life. Okay, so there's that. Okay, that's those. Now, if we were to do the straight line method, what would we do? Okay, we would do 10,000, the cost minus the salvage value divided by 5. Okay, and we would do what, $9,000 divided by 5. Okay, this number right here, $9,000 it has an actual term. It's called the depreciable base. Okay, it is essentially cost minus salvage. Okay, we expect to depreciate $9,000 over the life of this asset, because that's what we expect to use up during as long as we own it. Okay, in other words, we paid 10, it'll be worth 1,000 at the end, so 9,000 needs to be divided up and depreciated over 5 years. Okay, so if you do that math, it's 1,800. You see on the screen. But what I'm trying to say here is, this is all that we're going to depreciate. We're going to depreciate all of that. So we're going to depreciate 100% of this $9,000. And this can be depreciated over 5 years, which gives me a percentage of 20%, right? Okay, you can do that math, right? So if we're going to depreciate 20% per year of this $9,000 doing this method, we can say it's got a 20% depreciation rate. Every year we'll depreciate $20,000. Sorry, 20%, I said totally wrong. 20% of the $9,000, which is the depreciable based cost minus salvage. If we're going to do the double declining balance method, we're going to double this rate, and we will do 40% as our depreciation rate. Okay? So in the accelerated method of the double declining balance, or the declining balance, for this example, we're going to do 40%. Okay? I just showed you the calculation. So let's look at this, all right? I got Excel here. Let's get some stuff going on here. Let's see. This is going to be cost. Let's see. I don't want to call it cost. I'm going to call it book value. Okay. B is going to be rate of depreciation. I'll fix it here in a second. Depreciation. Okay. This will be depreciation expense. This will be ending book value. Come on, can't type. And then over here, we're going to do accumulated. That's spelled wrong. Okay, let's see if I can fix this. Let's see. Wrap. Let's do a wrap. There we go. That looks a little better. Okay. All right. So when I do this, you got to remember that your starting book value of this asset is not cost minus depreciation. I'm sorry. It's not cost minus salvage. It's just cost. Okay. Book value. I need to move it over a spot. Dang. Can I insert? I can. Good. And let me drag this over one. Oh, hang on. Catch it on the edge. There we go. Oh, I gotta fix it now. Okay. All right. Doesn't this look great? Okay. So this is way too big, by the way. Let's drag this up some. That'll work. All right. So we're going to start off with a $10,000. Okay. Let's make this all look like, well, hang on, let's have it looking right. Okay, let's see. Format cells. I should have pre-did this. I'm sorry. This will be a percentage, no decimals. And these. And let's see this. Oh, hold on. Nope. Hold on. There we go. I got it now. These are going to be accounting, no dollar signs, and no decimals. Well, let's do 2 decimals. All right. So here we go. So remember that rate of depreciation? I just did it on the board, right? So in this problem, remember, so we got $10,000 for our cost. Our salvage value is $1,000, our 5-year useful life. If we're doing straight line method, you see it here. 10,000 minus 1,000 is 9,000. You see it over here, and 5-year useful life. Okay, what I'm trying to say here with this the $9,000 is what needs to be depreciated over the 5 years. The entire amount will be depreciated over 5 years, which is 100%. So 100% of this $9,000 will be divided by 5 years, which means each year 20% is going to be depreciated. Okay, 20%. This is the double straight line method. Okay, so we're going to double 20% to 40%. Okay, so for each year depreciation, we're going to do 40%. Okay, every year. All right. To calculate depreciation expense, we're going to multiply the book value times the rate of depreciation of 40%. So that first year, we will depreciate $4,000. Okay? So if this, well, I don't want to get confusing because you're going to see these ABs and C's at the top that are confusing. So the ending book value was going to be the $10,000 minus what we depreciate. In this case, $6,000. Okay? This $4,000 will get added. Remember, when we do the entry, if you can remember chapter 3, we're going to debit depreciation expense. We're going to credit accumulated depreciation. So we will add to accumulated depreciation. In this case, it'll be $4,000. Okay? And so the book value at the end of year 1 is now going to be the book value of year 2. Let's actually do a formula. So the book value of year 2 is the end of year 1's book value. We're just going to roll it forward, okay? Roll it forward. And now we're going to multiply that times the 40%, right? So equals 6,000 times 40%. So the second year will depreciate $2,400. Okay? So at the end of year 2, our book value will be the 6,000 minus the new depreciation for this year of $2,400. Okay? And our accumulated will be our $4,000 plus the new amount of $2,400. Loving it, right? Let's keep going. Our new book value for year 3 is going to be the $3,600. Okay? So our depreciation for year 3 will be 6,000. Will be the 3,600 times 40%, which is 1,440. Our ending book value is 3,600 minus the 1,440. Our accumulated depreciation will be the previous years plus the new amount. We're almost there. Okay, carry it forward one more time. Multiply times 40%. 864. All right. We still with me? Okay, here's our ending book value after year 4. Accumulated depreciation will be the previous year's depreciation plus the new amount. Last year, okay. Oop. This is where it's going to confuse you, so pay attention right here, okay? This is big, okay? Times, this will be the book value times 40%. Excuse me. Okay, there's a problem. Okay? This problem has a salvage value of $1,000. Okay? Just so you know, the cost, the salvage value, and the life. Okay, let's have them over here. Okay, we got 10,000. Oh, that's a percentage column. Hey, gummit. 10,000, 1,000. It's okay if it's cut off. And then 5 years. Okay? Our salvage value is $1,000. Okay? If I do this the last year, this 518.40, look, my ending value is less than $1,000. So what you got to do in some of these problems like this here is we got to just kind of force it. Okay? We got to say, well, we can't depreciate $518.40. Okay? Because this must equal $1,000. So we are allowed to depreciate that last year. Watch this, $296. Oh my God, where'd you figure that out? Okay, yeah, the math doesn't work, but it can't work because we have to force it to have an ending value of $1,000. Okay, and now when you do your calculation for accumulated depreciation, you'll do the previous year plus the current year, and there's that $9,000 being depreciated over the 5 years. Okay, isn't that great? Love it. Okay, it's good. It really is good stuff. But it's just something you gotta remember, right? So it's just this thing about accounting. It's all process, and you gotta learn the process. That's the process for straight line depreciation. It's a little bit tricky. Okay, a little bit tricky. All right, back to the slideshow. Disposal of assets. Okay, disposal of assets. Look what it tells you to do. Here's the 4 steps. We'll do it on some problems, I'm sure. Okay, the first step is to catch up, update your depreciation until the date of the sale. Okay, so if you sell this thing, if you had it for several years, and during a year you sold it halfway through, then you would record depreciation up to that halfway point, make the entry, and then you would start doing the disposal. Okay, you have to catch up to the date of disposal with depreciation. The second thing is record the removal from the assets account balance. Okay, so we'll have to do a credit to the equipment account and a debit to accumulated depreciation. We'll see that when we get to it. We also will record any cash received or paid during disposal. Sometimes you got to pay for people, somebody to come pick it up. Okay, so sometimes there could be a cash outflow when you dispose of an asset. Hopefully, though, it'll be where we're selling it for some money, so there'll be a little bit of cash coming in. Okay, and then there's going to be a gain or loss. Okay, sometimes there'll be a gain, sometimes there'll be a loss, sometimes there'll be no gain or loss if you sell it for what it's worth on your books. Okay, look at what it says. We compute the gain or loss by comparing the book value of the asset with the market value of any assets received. Which, if it's cash, then it's the cash is that's what it's worth. Okay, sometimes you trade assets and you got to do what's the market value of the asset that we're getting for the one that we're getting rid of. Okay, but we won't have anything that complicated here. It'll all be like cash sales, okay, or maybe like insurance proceeds. Okay, so they're giving us money because of damage. Okay, this last slide deals with intangibles. Again, we're not going to do it. Okay, let's not worry about it. All right, so I'm going to take a quick pause, give me a soda, and come back, and we're going to do the Learn Smart right now. Okay, not the Learn Smart, the quick study. Okay. So I'm going to have two videos due here on Monday, and we're going to put them both up, part 1, part 2, and you'll be able to get chapter 10 done as early as you want to. You want to wait till Sunday, otherwise you can have it done tonight, okay? You can be ready for next week tonight. So here's a quick pause. I'll be back in here in about 5 minutes to record the second part of... let me do the quick study. I had a momentary blank out there. But anyway, we're going to do the quick study here in a minute. Now, here's your question for the discussion board, and we'll put it up before I come back. The first question is to tell me what we call depreciation for natural resources and what we call depreciation for intangibles. Okay, so and I addressed this at the very beginning of the video. Once I got past me talking, getting ready. So, what do we call depreciation if it's natural resources, and what do we call depreciation if it's intangible assets? That's your question. They'll be up shortly. I'll be back in a few minutes to do the quick study.